Egypt's central bank has raised key interest rates, as I mentioned a little earlier, by 200 basis points. And that confounded expectations of economists who did not expect any change. The bank's Monetary Policy Committee hiked its overnight deposit rate to 16% from 14% at a meeting over the weekend. Now, this was the bank's first increase in rates since it aggressively hiked them by 300 basis points in November last year. Inflation, of course, since then has soared to a three-decade high since the country floated its currency on the 3rd of November. Annual urban inflation hit 31.5% in the month of April. The IMF has said that lowering inflation is key to keeping Egypt's economic reform program on track. As early as last week, the lender said that raising key interest rates could be an appropriate response and a tool that could be used to actually rein in those headline inflation numbers. Let's get the latest details on this particular rate hike and how the market has reacted to it. Yasser Kim joins us now live from Cairo with more data on this. Yasser, a lot of economists had not expected this rate hike. In fact, 13 of the 14 surveyed by Reuters said they didn't expect any change. So why is that, and what were the arguments for keeping policy rates where they were?
Yes, it was a shock to many, including me here. We didn't expect that one to come. Well, you have an economy that is trying to build the proper infrastructure to, for example, attract investments. And when you increase the rates, then you're actually fighting off the options for investment. Because if you take one side, the CBE wants by this to lower the prices in the markets, to lower inflation. How will that happen? People will not buy products. They will go and put the money in the banks to get better reward for it and save their money. So there will be a recession in the market, so investors will not be able to sell. At the same time, the loans and the imports will be much higher, so the cost of production will be higher, so the prices will be higher, and therefore they will be making losses. Actually, some would even think of closing down their companies and just put their money in the banks. They will get higher revenue than in production. One other thing is that the social side, the prices will be increasing because of the higher interest rates. It means higher return on the loans. It means higher prices, which will have a social effect. Yes, it could stabilize the Egyptian pound against the dollar if Egyptians put their money in the banks. But at this point, it will not be such a big difference that would require to take such a risk at this time. And this is why many, only some of the reasons why many have not expected this to come at this moment.
Indeed. The CBE, for its part, argued that the rate hike was needed. Of course, they argue that since inflation is slowing down and this rate hike is needed to preempt expectations of another continued rise in inflation. But clearly, the economists and the business people we've spoken to don't like that argument, do they?
Yes, it came out from the IMF, as many people think. It could be the IMF behind this decision, though the government and the central bank have been clearly saying it's the policies of the Egyptian government independently and not any push from the IMF. If we take this argument, well, the inflation, you know, there are two types of inflation. One is based on high demand on products, and to lower that demand, you increase prices. And the other is based on the part on the production, the formal production. In Egypt, it's not about demand because actually there is a shortage in supply because the government is not importing enough and is not producing enough. And what the exporters want, what the experts want, is that the government take other tools by increasing production, attracting investments, and trying to increase exports to get revenue. That will not need the government to increase the rates of interest, the interest rates. At the same time, the government should work hard on trying to look at other means than increasing what I mean by not controlling inflation through interest rates. The situation here is that, yes, on paper it's true that if you increase interest rates, it will help slow down the inflation. But in the market in Egypt, it will have a diverse effect or a negative effect, and will not help in putting down the inflation as much as people are expecting. Obviously, we want this to happen. We want the central bank to succeed in that. But the experts saying it will not work according to the Egyptian market and the Egyptian conditions.
Indeed. One last question for you, Yasser. Egyptian equities, they fell really steeply in trading today after Sunday's rate hike, down by about 2.5% on the EGX 30. How soon should we expect to see these higher debt service costs, as you've just mentioned, showing up on the listed companies' balance sheets? Will it happen immediately? Is it going to happen over 3 months?
Look, we don't expect the EGX to really go into the red, and what we've seen, the reaction today, to stay for too long. It will rebound very quickly enough, maybe by next week. So I don't think there is a lot of fear in this situation concerning the equities and the stock exchange in Egypt. It's expected to be temporary. And the central bank has said that, just going back to the interest rate, it's only temporary. It will not stay for long. We'll wait to see how long this will stay, the 2% increase in interest rate. So for the equities, this is only temporary. I will not be affected on the long term.
Indeed. We'll leave it there for the time being. Thank you for that. That's Yasser Hakim, of course, live in Cairo. And of course, when we get to the currencies bit at the other end of the bulletin, we'll also cover the reactions, a somewhat contrarian argument, in a little more detail.